Picture this. You're scrolling through your phone on a Tuesday night and you see yet another headline screaming about how the stock market is about to crash. Or maybe it's the opposite. Some financial expert on the internet is insisting that if you don't invest right now, you're going to miss out on the biggest rally of the decade. And suddenly, you feel this weird mix of panic and paralysis. Like, if you invest now and the market tanks, you're going to feel like an absolute idiot. But if you don't invest and it skyrockets, you're going to feel even worse knowing you missed out on easy money. So, what do? You probably do what most people do. You agonize over the decision. You watch a few more videos. You check the news. Maybe you talk yourself into timing the market perfectly, which, spoiler alert, is something literally nobody can do consistently. Or, and this is really common, you get so paralyzed by the decision that you do nothing at all. You just sit there with your cash, waiting for the perfect moment that never comes. Sound familiar? Well, what if I told you there's a way to completely remove this anxiety from your life? What if you could build serious wealth without ever having to worry about whether you're buying at the top or the bottom of the market? Spend way too much time thinking about the psychology of money, why people make terrible financial decisions, and how some simple strategies can completely change the trajectory of your wealth. If you've ever stressed about timing the market or wondered whether you should wait for a better entry point before investing, make sure you hit that subscribe button and give this video a thumbs up if it helps you see investing differently. Here's something that might surprise you. The people who are the most stressed about market timing are usually the ones who don't have enough money invested to matter anyway. Think about that for a second. If you've got $2,000 and you're obsessing over whether the market is about to drop 10%, you're stressing about $200. But you're probably spending more than that on stuff you don't need every single month. You spent more than that on your last vacation or that weekend trip where you tried a bunch of expensive restaurants. You probably spent more than that on things you bought online and forgot about within a week. So, here's the thing that really gets me about this whole market timing obsession. People will agonize for weeks about whether to invest their money, but they won't spend 5 minutes thinking about the impulse purchases that are literally costing them their financial future. They'll watch videos about whether the market is going to go up or down, but they won't spend an hour creating a realistic budget. The psychology is completely backwards, and it's costing people tremendous amounts of wealth. Meanwhile, the people with actual wealth are completely unbothered by daily market movements because they understand something fundamental that most people never figure out. They understand that market timing is a fool's errand, and consistent investing is a guaranteed path to serious wealth. The difference between these two approaches is not theoretical. It's not some philosophical debate between academics. It's actual money in your pocket, and the gap is enormous. Let me show you exactly what I mean. Imagine two investors. Let's call them Sarah and Tyler. They both have the same amount of money to invest, and they both want to build wealth over the next 30 years. Here's where they differ. Sarah is a market timer. She reads the news constantly. She watches CNBC. She listens to podcasts about whether the economy is headed for a recession. She checks her portfolio multiple times per day. And most importantly, she tries to buy low and sell high. She'll sit on cash for months waiting for the perfect entry point. Then, when the market drops 20% and everyone is panicking and selling, she finally convinces herself that now is the time to buy. But by the time she pulls the trigger, the worst is already over and the market is starting to recover. Or she gets spooked by a market pullback right after she invests her money and she sells at the worst possible time. Sarah is constantly second-guessing her decisions and rearranging her portfolio. Tyler, on the other hand, is boring. Incredibly boring. Tyler has set up an automatic investment of $250 per month. It happens without him thinking about it. The money comes out of his paycheck, goes straight to his investment account, and gets invested in a simple index fund. Tyler doesn't check his portfolio very often. He definitely doesn't try to time the market. He doesn't care if the market drops 30% next month because he knows that lower prices just mean his monthly $250 is going to buy more shares. He's actually excited about market downturns because they're like a sale on his investments. Tyler is consistently, mechanically, almost robotically putting the same amount of money in every single month, month after month, year after year. And here's the crazy part. Over 30 years, Tyler absolutely crushes Sarah. Not a little bit. Not even by a significant margin. Tyler ends up with substantially more wealth, less stress, and a much better financial life overall. How is this possible? How does someone who isn't smart about markets, who doesn't try to beat the system, end up with more money than someone who's actively trying to optimize their returns? The answer is something called dollar cost averaging, and it's one of the most powerful and underutilized concepts in personal finance. Dollar cost averaging simply means investing the same amount of money at regular intervals, regardless of what the market is doing. You invest $250 this month when the market is at $4,000. You invest $250 next month when the market is at $3,500. You invest $250 the month after that when it's back up to $4,200. You don't get excited about it. You don't get depressed about it. You just do it mechanically over and over again. And over time, this approach creates something that most people don't even realize is happening. It smooths out all the ups and downs of the market, and it guarantees that you're buying more shares when prices are low and fewer shares when prices are high. You don't have to be smart about it. You don't have to predict the market. You don't have to make any decisions at all. The math just works out in your favor automatically. Let me show you why this works with some actual numbers. Let's say the market is going to follow this pattern over 12 months. It starts at $100 per share in month 1. Month 2, it drops to $90. Month 3, it bounces back to $110. Month 4 drops to $85. Month 5 goes up to $120, and so on, with the market oscillating up and down as it always does. Sarah, the market timer, looks at this and thinks she's clever. She thinks she can buy at the lows and sell at the highs. So, she waits. She waits for the market to hit $85 in month 4, and then she invests her entire $3,000 at once. Boom, she buys about 35 shares. Then she sits and watches. The market bounces around, and eventually it ends the year at $95. Her $3,000 investment is now worth about $3,325. Not terrible. She made a return. But here's the problem. She had to correctly predict that month 4 would be the low point. What if she'd made a small mistake and the market dropped to $80 in month 6? She would have bought at $85, thinking she was getting a deal, and then the real bottom would have passed her by. Tyler, meanwhile, invests $250 every single month. Month 1 at $100, month 2 at $90, month 3 at $110, and so on. By the end of the year, he's bought shares at an average price of about $100 per share. Even though he never tried to time the market, even though he just invested the same amount every month, he ended up buying at exactly the average price. Sarah also ends the year at the market average of $95. But remember, she had to nail the timing to get even close to that. And in real markets with real people, people usually don't nail the timing. They usually get it wrong. They either invest too early or too late. Meanwhile, Tyler is always investing at the average price because his consistent approach guarantees it. But here's where the real advantage shows up over longer time periods. Let's zoom out and look at 30 years of investing instead of just 12 months. Tyler invests $250 every single month for 30 years. That's $90,000 of his own money going into his investments. At an 8% average annual return, which is actually pretty conservative compared to historical stock market performance, his investment grows to about $400,000. The vast majority of that growth, roughly $310,000, came from market returns and compound interest, not from his own contributions. He literally earned more than 3 times his investment just by being consistent and giving the market time to work. Sarah, meanwhile, spends 30 years trying to time the market. Some years she nails it. Some years she gets it completely wrong. On average, her market timing ability cancels itself out, and she gets approximately the same market returns as Tyler. But here's the critical difference. Because Sarah is trying to time the market, she's often sitting on cash waiting for the perfect entry point. So, instead of investing that $250 every month for 30 years, she might only be invested for about 22 of those 30 years. She's missed out on 8 years of compound growth because she was waiting for the perfect moment. Her investment account ends up at around $280,000 instead of $400,000. Same market returns, same financial markets, different outcomes. The difference is that Tyler was consistently invested and Sarah wasn't. And that missing 8 years of compound growth cost her over $120,000. Let me say that again. Because Sarah tried to time the market, she ended up with $120,000 less than Tyler. And that's probably being generous. In reality, she probably did a bit worse because market timers don't just sit on cash. They also tend to get spooked by market downturns and sell at the worst possible time, which crystallizes losses and forces them to buy back in higher. So the gap between the consistent investor and the market timer is probably even bigger than $120,000. But here's what's really interesting about this whole thing, and I think this is the part that most people miss. The difference between Tyler and Sarah isn't intelligence. It's not knowledge. It's not even income level. The difference is psychological. Tyler made a decision once to invest $250 per month automatically. He set it up, and then he forgot about it. He doesn't read the news obsessively. He doesn't watch his portfolio constantly. He doesn't second-guess his decisions. Sarah, on the other hand, is emotionally exhausted all the time. She's reading headlines about market crashes. She's watching her portfolio bounce around. She's constantly questioning whether now is the time to invest or if she should wait a bit longer. She's experiencing emotional roller coasters that Tyler doesn't even have to think about. And that emotional exhaustion is what causes her to make bad decisions. That's what causes her to sell at the bottom or delay investing when she shouldn't. It's not that she's dumb, it's that she's emotionally drained, and that emotional exhaustion is costing her tens of thousands of dollars over her lifetime. This is why I'm so passionate about automated investing. It's not just a financial strategy. It's a mental health strategy. When you automate your investments, you remove your emotions from the equation. You can't second guess yourself if the decision was made before you woke up that morning. You can't panic sell if your money is automatically being invested regardless of what the news is saying. You're essentially using automation as a psychological tool to protect yourself from your own worst instincts. Now, you might be thinking, but Nick, what if I invest $250 per month and the market crashes immediately after I invest? Doesn't that mean I'm putting money into a losing investment? And yes, technically that's true in the short term. But here's the thing that separates people who build wealth from people who don't. People who build wealth don't think in terms of short term. They think in terms of decades. When the market crashes and your investment account value drops by 20%, that's not a disaster. That's a feature, not a bug. Because you're about to invest $250 again next month, and that money is going to buy more shares at the lower price. You're essentially buying your investments on sale, and you should be happy about that. The person who freaks out when the market drops and sells at the bottom is the person who locks in losses. That's the person who turns a temporary 20% decline into a permanent loss of capital. Tyler doesn't care about the decline because he knows he's going to be investing $250 every single month, regardless of whether the market is up or down. So a market crash actually benefits him because his consistent contributions can buy more shares. This is a fundamental mindset shift that most people never make. They think of market downturns as scary. But if you're a consistent investor with a long-time horizon, market downturns are opportunities. They're like Black Friday sales, except they're for stocks, and they happen to your actual retirement portfolio. Think about how excited you get when your favorite store has a 30% off sale. You probably go in and buy things you've been wanting because the prices are amazing. But when the stock market drops 30%, most people panic and want to sell. They're essentially running away from the sale instead of embracing it. It's completely backwards when you think about it rationally. If you love getting a good deal on consumer goods, you should absolutely love getting a good deal on the underlying assets that will fund your future financial freedom. A market crash while you're consistently investing $250 per month is literally the best thing that could happen to you. Your money is buying more shares. Your average cost basis is getting lower. You're essentially getting wealthier while everyone else is panicking about their portfolio values. That's the asymmetry that most people don't understand. Here's another thing that people don't realize about consistent investing. It removes a huge source of decision fatigue. Decision fatigue is real. Every single decision you make throughout the day depletes your mental energy. By the time evening rolls around, you've made thousands of decisions and your willpower is completely depleted. This is why you're more likely to order takeout at 7 p.m. than at 1 p.m., even if you were planning to cook. Your brain is just tired. When you automate your investment contributions, you eliminate an entire category of decisions. You don't have to decide whether to invest this month. You don't have to wonder if now is a good time. You don't have to check your portfolio balance to see if you're up or down. The decision was already made. The money is already being invested. You get to redirect all that mental energy toward things that actually matter in your life. You get to be present with your family instead of obsessing over your portfolio. You get to focus on your work instead of watching market news. You get to sleep better at night instead of lying awake stressing about whether you made the right investment decision. This might not sound like a huge advantage, but it's actually one of the most underrated benefits of consistent automated investing. Your peace of mind is worth something, and consistent investing buys you that peace of mind for free. Now let's talk about something that's going to make you feel better about potentially investing right now, even if you think the market is expensive or overvalued. The data on market timing is pretty brutal if you're someone who wants to time the market. Every study that's ever been done on this shows the same thing. The average investor who tries to time the market significantly underperforms buy and hold investors. And I mean significantly. We're talking about multiple percentage points per year. which compounds into tens or hundreds of thousands of dollars over a 30-year period. You know what the best time to invest is? Right now. And if you can't invest right now, the second best time is next month. And if you can't invest next month, the third best time is the month after that. There's never a perfect entry point. The market is always going to feel expensive to someone, and it's always going to feel cheap to someone else. The only certainty is that if you wait for the perfect entry point, you'll be waiting forever. Meanwhile, the person who just invests $250 every month without overthinking it will end up far ahead of you. Here's the uncomfortable truth that nobody wants to hear. If you spend 6 months analyzing markets trying to find the perfect time to invest, and during those 6 months your friend is just investing $250 every month, your friend is going to end up ahead of you, even if you think the current market valuations are ridiculous. Your friend will have invested $1,500 during those 6 months, and even if the market drops 20% after he invests that $1,500, he's still ahead because his money is now being deployed. Meanwhile, you're sitting in cash earning 0% return in your bank account, thinking you're being smart by waiting for a crash. You're not being smart. You're being penny-wise and pound-foolish. You're saving yourself from a potential loss of a few $100s while costing yourself thousands or tens of thousands of dollars in long-term wealth. The best strategy isn't to find the perfect time to invest. The best strategy is to invest consistently and give yourself the longest possible time horizon. If you've got 30 years until retirement, trying to perfectly time your entry into the market over a 30-year period is literally the dumbest thing you could do. You're trading away a fortune just to potentially save a few $1,000s, and you're probably not even going to save that because you'll second-guess your timing anyway. Instead, what if you just accepted that you're going to invest $250 every month no matter what? What if you removed the decision entirely and just let the automation handle it? You'd end up with hundreds of thousands of dollars more at retirement, and you'd lose zero sleep in the process. That's the trade, and it's the best trade you're ever going to make. Let me talk about one more thing that makes consistent investing so powerful, and it's something that most people completely overlook. Consistent investing forces you to develop discipline in other areas of your life. When you commit to investing $250 per month, you're essentially making a commitment to yourself about your financial priorities. You're saying, no matter what happens, no matter what I feel like doing, no matter what emergencies come up, I'm going to invest $250 per month. And when you start honoring that commitment, something interesting happens. You start honoring other commitments too. You start following through on other financial goals. You start saying no to things that don't align with your priorities. You start having conversations with yourself about what you actually want in life versus what you've been mindlessly pursuing. The person who can stick with a $250 per month investment plan for 30 years is the person who's going to make better career decisions. They're going to negotiate higher salaries. They're going to pass on stupid purchases. They're going to build a life aligned with their actual values instead of defaulting to whatever society says they should want. Consistent investing doesn't just build wealth, it builds character. And character is what actually determines long-term financial success. If you're waiting for the perfect time to start investing because you think the market conditions aren't right, you're making an excuse. You're telling yourself a story that lets you stay comfortable right now instead of doing the hard work of building wealth. But here's the truth. There is no perfect time. There will never be a time when everything feels safe and secure and optimized. There will always be headlines about economic uncertainty. There will always be reasons to wait just a little bit longer. And if you keep waiting for perfect conditions, you're going to be waiting your entire life. I've talked to people who've been waiting for the right market conditions for 15 years. 15 years they've missed out on some of the biggest bull markets in history because they were waiting for the crash that never quite happened the way they expected. Meanwhile, someone who just started investing 15 years ago with $250 per month would be sitting on over $300,000 right now. That's the difference between waiting and acting. That's the difference between being paralyzed by analysis and being empowered by action. You don't have to be right about the market. You just have to be consistent. Meanwhile, people who started investing 10 years ago in what felt like a scary market are now sitting on a fortune. People who started investing 20 years ago are basically wealthy. And people who will start investing tomorrow and stick with it for 30 years will be essentially financially independent. The timeline doesn't change. The mathematics don't change. What changes is how much time you give the market to work its magic. So start now. Invest $250 per month, set it up automatically. Then, and this is important, forget about it. Don't check your portfolio daily. Don't read headlines about market crashes. Don't try to optimize your entry point. Don't try to adjust your strategy based on what some talking head on the news is saying. Just invest $250 every month. Assume you're going to earn about 8% annually on average, and let time and compound interest do the heavy lifting. After 30 years, you're going to have several $100,000 that you built on the back of simple, consistent investing. And the most beautiful part? You're going to have done it without any of the stress and anxiety that comes with trying to time the market. You're going to have a fortune, and you're going to have peace of mind. And honestly, the peace of mind might be worth more than the money.